All right, I think this is recording. Uh, yeah, okay. So, quick video here. Working on, let me go to this here, trade on American Airlines here. I'm doing these double diagonals, kind of like a calendar spread. So, let's see if I can move my head out of the way here. There we go. Okay, so I've got this trade set up. I went into analyze here. Here's the trade that I'm looking at doing. It is, let's see, it's basically like you're buying and selling a strangle, but with different dates. So what I'm going to buy is November 46 call and a 33 put. Okay, and there's my cost on those. And then I'm going to sell the October 5th, which is 28 days out, the 37 put and 43 call. So notice there's a $4 difference on the put side, $3 difference on the call side there. That's your max risk on that is $300. Like if that for some reason went all the way up to 46 or something, which is way up here in 28 days, which I mean, you know, that could happen, but that's not very likely. That doesn't gap up trade that crazy usually. So, and I'm kind of playing a little bit of a support here. Looking at implied move is about 270. So yeah, you're like at $42 or something. Kind of your implied move is about up to here. That's probably about right. I mean, this has been kind of trading up and down a little bit here. There was a big drop back here, but for the last, I don't know however long it is, a month, 2 months or whatever, it's been right in there. So what this does is with this setup, you're kind of cashing in on the theta, the time decay here mostly. You're selling this one for 55, this one for 20. That's $74. You're going to keep that. You're only buying these for like 88 or something here. So anywhere in between here at expiration is profit, and here's kind of earlier than expiration. The purple numbers down here would be this line, like if it was on 929. You've still got $30 profit there. Now at expiration, if it's in the center, both of your long calls aren't going to be worth as much. So the max profit is actually when you get close to your strikes. That means that call or put on this one would be on the call side here would be got a little bit more room that side. That long call would be worth a little bit more, but still your one that you sold would be zero. So that's why you're more profitable here then. So I set my break evens here, and kind of move around since I've been messing with this. But so there's your break evens, and that's what the yellow line is on the chart here. So anywhere in between there is going to be profit. So I'm going to go ahead and execute this trade. I have it saved here. So let's see what we get it filled here for. $11 would be nice. Let's see. Let's try for 10 here and see what happens. The buying power effect, $400. That's the difference. The difference between those two strikes. You're not spending that, but it's kind of like doing a credit spread. There you got it filled. So filled at 9 or 10. It looks like at $9. So $9. So we'll go back here. So all right. So we spent $9 here on this thing. All this has to do is stay between here and here, 28 days, but I'll show you something that's kind of cool. It doesn't actually have to go into expiration before you can cash out here. So $9, you know, if you're looking, I don't know, let's just say if it's right in here on the 29th, what's our profit there? $62 on that. It moves, right here's our current price. It moved down a little bit. You know, you may still grab, what's that, $64 in that area. Yeah, watch the blue number at the bottom left. Let me get rid of the earlier one. All right, so right over here is going to be about zero. You're not going to make anything. No big deal. Move on. All right, but look, even if it goes kind of past your 37 strike is the one that we're selling, your 43 call. That's your max profit zones there. But we got kind of the swoop in the middle. That's fine too. So anywhere in between there's money. All right. So yeah. So on this side you can make $72 if it goes down into that range, that 37 range. If it goes all the way up to the 43 range, you're gonna make $140 on that one. Then the theta on this, I kind of want to see. Hold on. I don't know if maybe I'll see this other screen. Theta on that says 124. So like I said, it's not going to be a real fast moving trade. You're going to hold this one for a little while. So you're making $1.24 a day basically is what it's now, just sitting there. So going back to that screen there. Okay, so going back to that screen, this thing can go up in here, right in here. Off of your $9, you're going to make, what was it, about $60 there, and forget what our price was, $140. If it closes somewhere up in here, you're going to make $100 or something on this trade. So, and even if it's flat, if it just stays right where it's at from now until expiration, you're going to make $44 on that. So I've spent maybe the last month and a half kind of working on these. So hopefully that makes sense. Let me show you one other thing too. So the time decay is, if you're buying straight options, is something you're always trying to kind of outrun. The stock's always got to outrun that time decay. On this trade, let me pull up. I've got one open on McDonald's here. It is, I bought it for, I think it was like 310 or something. And I'm not going for big percentages on these. What I've been doing is closing them out 10 or 15% earlier than expiration. Your risk at expiration gets a little bit higher, obviously, but there's obviously more profit. But if you can grab 10 or 15% every few days on these, you're still profiting there. So like if you bought straight calls, your time decay is just killing your your position on that. What's happening here is I've got a sell order in for 355. Okay, so I bought it for like 310. I've got a sell order for 355. This red line, this sell order is chasing the stock here. If that thing cannot outrun it because of time decay, this is moving towards the stock price. Okay, if this can't outrun that, it's going to fill then. So if it keeps going up, yeah, you may not get a fill, but our my expiration on that is, let's see what my expo on McDonald's is. That is, September 21st. So it can, between now and the 21st, it could come up into here and then even come back in, and you're still going to wind up in max profit here. You might be a little bit of a loss if it gets that high. I also use the implied moves and support resistance a little bit in here. I think we have some right in this area too. So I kind of use all that to determine where I'm comfortable with taking risk above a certain level. But with having that time, you can sell the weeklies against your long calls, but your risk, I've found, is a little bit higher if it overruns your strike price. With this, it can overrun the strike price, and it's got time to come back in within that range to where you can still get it sold and profit. And if it doesn't overrun the strike price, it just stays flat in the middle, you're still going to get a fill for a profit even earlier too, just because of the time decay. So what is happening right now with this thing is it's trying to outrun this, but you can see where that line's at. This line, as time goes on, today, tomorrow, it's still creeping up here. Okay, so at any point in time, if it just dips back down to about where it was, at some point today too, it's going to get a fill. So that line's kind of chasing it for the fill then. So let me know if you have any questions on any of this stuff. I'm still kind of learning it, but I think if you go on the team trade sheet, I think, let me look at what I've had. It was let me see if I can screen sharing. Oh, it's cool. And share. Here we go. Share. Screw. Boom. There. Okay. So you should be seeing this sheet, I believe. All right. So this one's closed. That one I just set these sell orders and then just wait. So it's not really a stressful trade. Time is the only thing that's consistent. It moves forwards. Great. As time goes on, you get a fill on it. That's it. So here's kind of the ones I've done here. The one loss that I had, I wasn't doing the double diagonals, which is where you're selling the puts and calls. I was only on one side, and Costco, if you've seen, kind of overran quite a bit. So yeah, it's that one I lost. I was like 207 down on that. And so what I also did here too was, if we did just one contract on each of these, I mean, it's pretty minimal cost on most of these. They're up 363 then. So yeah, so it's 12 wins, 1 loss so far. So win rate of 92% is what we got. So anyway, that's all I got so far. It's, these are, I guess, a double diagonal calendar spread, something like that. Similar to strangles, iron condors, vertical spread. It's a mix of a little bit of everything. So